Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. About a month and a half ago, March corn made a double bottom, and after the market made a double bottom near support, our finding has been that it's rare that double bottoms will terminate downtrends. From this double bottom, the market moved up to resistance near the 360 number and has since been in a steady decline. We're now currently looking at a potential time factor where the market has come in and suggesting that the market could very well be making a low. The tangent line to the end of our actual circle here suggests that any day now or sometime this week, the market does have the capacity to put in a reasonable low now that we have exceeded the lows of the previous double bottom areas. In the event that this market continues lower, we do think that the next level to look out for is near the 340 number, and a breakdown somewhere in the neighborhood of 345 to 340 is a good area for this market to make a significant low, from which point the market can finally start to recover. The current lows for this March contract happens to coincide with our 360-degree mark at 347.5. And just below, we also do see our volatility-based support lines coming in to give us potential support as well. Lastly, we're looking at our sinusoidal natural trend line coming in just below near that 345 mark. So once again, that 345 to 340 number does look like a very good area for a potential low to come in. In like formation, we can see the double bottom that came in on the May contract, and now we have a marginal break of those previous lows coming in near 355, with the potential of finding support near that 355 number that we've seen over the past couple of days. The last thing we'd like to point out with this contract is that at the end of the week, we do have a time factor coming in. So it is possible that this market can continue to move sideways going into the end of the week. And as we march into the Christmas holiday, from there, the market can then potentially start to make its way back up. The 360-degree mark for the May contract rests at 351. So 351 to 355 is a good area for this market to put in a potential low. The minimum price objective for the January soybean contract that we were looking for was at about 960. That price objective has since been met, and it appears that the market could very well be on its way down to about 947 and potentially lower. Managed Money has been unloading a number of their previously long positions, and it appears that the soybean market may have a bit of softness for the balance of the month. Most recently, a support resistance indication was formed on the chart a couple of days ago. But despite that having been formed, the market continues to find weakness, suggesting that a push down to 940, possibly as low as retesting previous lows near 930 is possible. So for now, as we look at this market, we're seeing a potential continuation pattern where the market dropped, had a bit of acceleration in between, and we could see another drop coming in that could touch somewhere in that neighborhood of that 940 number previously discussed. From here, we simply would want to wait till some support does come in, but it does appear that the January contract looks to have continued weakness into the end of the month, at which point we'll transition to the next forward contract for additional analysis. On the July contract, we're highlighting a number of arc swings that were taken for this particular contract off of a scaled swing. In doing so, we wanted to highlight the way in which the markets sometimes like to respect these arc swings when the market comes to meet these areas. The market came in and touched both of these areas and had a nice advance to the upside. And the next time it broke it, we can see here that the market hit our 1-by-1 angle and then made its way back up again. The next arc swing that we're looking at made a low right at the circle. The market made an advance up to our 2-by-1 angle. And then the next drop that we find came in on another arc swing. And again, the market ran up to the next 2-by-1 angle. The most recent swing that we're looking at shows where the market broke the 1-by-2 angle, and in doing so, it often will make a move down to the next 1-by-2 angle below. This area now happens to coincide with where the actual next arc swing hits, and if the market is able to make a bounce from here, we would anticipate a small bounce perhaps up to this 1-by-2 angle above, and if it can find continued strength, perhaps a nice rally upside. It remains to be seen what the market can do in the event of a bounce up to this area here, But for now, we are not looking to stand in front of this freight train as the market looks to have continued weakness. One standard deviation below the point of control of 1,009.25 is at 981.5. And that 981.5 number happens to coincide with our line in the sand level at 980. In the event that this July contract breaks 980 this week, we anticipate continued weakness to the downside with the potential of reaching down to about 952. If it is able to hold this 980 this week, then we think a nice bounce to the upside is possible. For this week, then, we're looking at that 980 as a very important number, as the 980 number could very well determine for us the direction upon which we think this market can go. We've long have been discussing the divergence formation that we have seen in the wheat complex, and we can see as the market has made subsequent lows that the strength has been reducing. Finally, the market now looks to have made a significant low right up against our 1x1 angle, and we can see current resistance right now at the 360-degree mark at 424. If you recall, on several occasions, we've discussed how important this 424 level has been for this particular contract, and it is of no surprise to us that we find exact resistance right up against that 424 number, up against our time factor that hit between today and yesterday. From here, if the market's able to hold above this 410 number and make a minor correction to the downside and turn back up again, we do believe that upside potential of a minimum of 445 is likely for this contract, with the potential of reaching 466.25 in the not too distant future, sometime in January. From this vantage point, we can see that the market touched right up against volatility-based support and made its way back up. And from here, again, that 424 number continues to be very important for this contract. In the event that we're able to close above the 424 this week, we do think, again, that upside potential of either the 270-degree mark or the 180-degree mark are probable for this contract. The US dollar is moving as would be expected for us, with very good resistance up against the 180-degree mark near $94. At this area here, the market had initially been a bit sideways, and now it's starting to move to the downside just a bit. And this is consistent with what we've anticipated for a potential move to the downside with the US dollar. Especially currently in the face of pressure from cryptocurrencies, as capital starts to migrate its way out to some of these cryptocurrencies, it is possible that the dollar could find continued weakness in the face of this migration. Downside support then that we would be looking for a potential move initially rests at the 360-degree mark near $92, and beyond that, a downside target somewhere in the neighborhood of $90 is possible for the US dollar. Taking a look at the longer term weekly chart, we can see exactly what we're talking about here. Market made a very nice low at the A or 1 mark. Then we're finding a corrective move up to our B leg, where we found very good resistance overhead. Either the market could potentially make its way up to about $96, but in the event of a failure here, we're looking basically at a smaller ABC correction to the downside that could very well make its way down to about $90. So it still remains to be seen the way in which this market looks to make its move, but from the weekly perspective, it does appear that a move to the downside is what we're looking at in the near term for the dollar. Thank you for joining us for our weekly market update. We'll be wrapping it up for this year and look forward to seeing you again in January.